Hi, it's Maurizio from talkaboutwealth.co.za, and today I wanted to ask a question which is actually quite important in wealth management, especially for people that are still saving, generating their wealth, building their wealth, and for those that are investing their current wealth or current savings. And that question is, what is a unit trust? What does it do? How does it work? And are all of them good? Can you just go into any of them, and what is the general process in looking at something like that? Obviously, I won't go into too much detail in a video, but a unit trust can be a great savings vehicle. One of its biggest advantages is that it's very, very cost effective, and it's very easy to gain entry into. Unit trusts were developed for investors that didn't just have R1 million or 10 million rand sitting around to diversify their portfolios into a multitude of asset classes, or one asset class, or one sector. And that's the other thing about a unit trust, is that it's a vehicle that allows you exposure into multiple asset classes, or one asset class, or one sector, depending on what type of exposure you're looking for, what type of risk, how much of volatility are you willing to take on. And that's a discussion for another day. But unit trust is basically a pooled investment. It takes in thousands, hundreds of thousands of investors' savings on a monthly basis or a lump sum basis, pools them together, and you basically own a number of units in that trust, and that gives you ownership of whatever that trust is buying. And that might be shares, it might be listed property, it might be cash instruments or bonds, and that unit trust might even have exposure to foreign investments. Speaking of foreign, in America they're actually known as mutual funds. Pretty much the same type of thing, without getting too technical. But yes, a unit trust is generally a very good savings vehicle. Obviously, to answer part of the question, you shouldn't just go into any one. Just because a unit trust is very easy to get into and can be very cost effective, if you're going into the wrong one and don't understand what it's investing into, you could be in for a good hiding. In 2007, if you had gone into a direct equity unit trust, or a unit trust that only invests into equity, you would have gotten walloped when we had our recession in 2008. And that being said, you would have probably recovered quite well after that. But if you had not known what was going on and had just blamed it on the unit trust and pulled your capital out, then you wouldn't have recovered. So obviously you always get advice on things like that. But unit trusts come in varying sizes and shapes, and can match any investor's needs. The only thing it really just does not match is personalization. You can't phone Alan Gray or Coronation and say, hey, I like your balance fund, but my parents died of cancer and I don't want British American Tobacco as a share in that fund. They won't listen to you. The problem is that some unit trusts can be too big. Unit trusts that is billions and billions of rands in it can struggle to move around if it needs to. And obviously keep in mind that where there are losers, there are winners, and when there are winners, there are losers. So you are going to get unit trusts that underperform, and you need to be careful with that. Just because equity markets are running at the moment doesn't mean that by going into Joe Bloggs's soap unit trusts, you're going to be doing extremely well. You might do well, but relatively speaking, if you go into a manager that has a good pedigree and a good management, and looks good moving forward, you're obviously going to do much better there. So the bottom line is, unit trusts are great. They're much better than related insurance products that are out there. But be careful which ones you go into. Make sure that your return and risk expectations will be met by them. And always check out the fund manager and make sure that the pedigree is good.